There's a major development underway right now that could change the entire industrial real estate market in North America. And I'll get right to the point. The merger between CP Rail and Kansas City Southern has the potential to radically transform transcontinental rail traffic. And to get a better sense of how impactful this will be, we first need to observe that for nearly 200 years, freight traffic in North America has moved east to west. Not only did this lead to a staggering amount of infrastructure, but our society itself has been largely shaped by the rail network. Where this merger stands to alter the landscape is based on the fact that it will be the first single-line rail network that connects the US, Canada, and Mexico. And if you take a look at their rail network, it's easy to see how there can be a dramatic shift away from this east-to-west traffic to north and south traffic instead. I'm going to get into the significant implications this can have on the warehouse industry, but I first have to thank KC Conway, the Red Shoe economist who introduced me to the significance of this monumental merger. I'll put a link to the full interview I did with him in the description below. I knew of the acquisition before my interview with Casey, but he pulled back the curtain on just how transformative this will actually be. And to bring you up to speed if you haven't been following this story, last year saw a bidding war between CP Rail and CN Rail as they both jockeyed to buy Kansas City Southern. It ultimately ended with CP agreeing to pay $31 billion, and the acquisition was completed just a few months ago. Technically, KCS's shares will be put into a voting trust until the regulator, which in this case is the Surface Transportation Board, approves the transaction. It's expected, or hoped anyways, that this approval will come sometime later in 2022. While it was a newsworthy story, I didn't fully appreciate why these two giant rail companies were clamoring to make this purchase. But it stands to reason that anytime a company is purchased for $31 billion, the buyer is expecting to make a correspondingly sizable return on their investment. So let's unpack how they might earn this ROI. Naturally, by creating the first single-line rail network that spans the US, Canada, and Mexico, they can much more efficiently transport freight across those countries in comparison to the currently available model of having to involve various providers. But as I looked into this further, I believe there are much bigger plans in the works than just making it easier to move goods between countries. If you look at all the major rail networks right now, a significant amount of cargo arrives at western or eastern ports. And it's no secret that these ports have had considerable bottlenecks. Warehouse vacancy rates in some of these port markets are approaching 0%, and land constraints are making it prohibitive to even add new inventory. And since the cost of living is higher in these coastal cities, labor costs by extension are adding expenses to the supply chain. Now contrast this to port cities in southern US and Mexico. If we take a look at this map, we can see how this now opens up considerably more options. The port of Lázaro Cárdenas, for example, handles over 1 million TEUs each year, and it's a deepwater port that can handle post-Panamax ships. Then there are all the other major ports, such as Altamira, Corpus Christi, and New Orleans, to name just a few that will have direct rail access. Not only do these ports have much less of a backlog in container traffic, but labor is much more readily available and less expensive. And of course, these areas have historically been much more business-friendly and tax advantageous compared to some of those coastal markets. While there's undeniably merit in protecting the environment and the workforce, California is putting forward new regulations surrounding warehouse emissions and workplace quotas. I'm not in the position to make these decisions, but I can see somebody looking at it from this perspective. On one hand is a market with high rental rates, high taxes, high cost of living, and increasing regulations. On the other hand are cheaper rental rates, cheaper taxes, affordable cost of living, and a business-friendly government. And also there's considerably more land available for future expansion. And in the latter market, you'll also be able to transfer freight across the continent via a single rail company. So what does this all mean? It's a hunch, and it should go without saying that you should be skeptical of anyone on YouTube speaking in front of a bookshelf, which coincidentally has a Lego cargo ship and a series of books on rail. But I believe that this shift towards north and south rail traffic will open up a tremendous amount of opportunity for markets within direct proximity of the main rail line. More specifically, I'd be looking for areas with a close radius of major intermodal yards, particularly if they haven't already been built out extensively with warehouse space. These intermodal yards are designed for freight to come into the yard and then to get transferred by trucks to be sent out to the network of warehouses. So warehouse demand might see a noticeable uptick. But one other area that might have some potential is the manufacturing side. I think that there's a good chance we see more onshoring back to North America. There's always the risk that goods are stuck for too long at sea, or perhaps we see increased tensions or a trade war between the US and China. This problem could theoretically be averted, or at least mitigated, by reshoring production back to North America. And again, when you consider how efficiently goods can be shipped by rail across the 3 countries, the economic power of this merger is enormous. This corridor, running straight through the US, could very easily shape the economic landscape for the next few decades, or perhaps even centuries. And while there are already a series of industrial hubs along the route, there's a lot of untapped potential in many other markets. Again, do your own due diligence before you make any decisions. But I think land and warehouse space along this corridor, particularly close to the ports and major intermodal yards, is going to become quite highly sought after. Now, I'm not suggesting that major markets like Los Angeles, New York, or Vancouver are going to lose their appeal. These are world-class cities for a reason, and they'll undoubtedly continue to be major hubs for the foreseeable future. But they also have major hurdles to overcome for future growth, and I have to imagine the rail executives had this in mind when they decided to spend $31 billion on this acquisition. I'd love to hear your thoughts on this as well. What do you think this rail merger is going to do for the industrial real estate landscape? Where are you seeing opportunities right now? I'd love to hear what you have to say. Leave a comment below. If you enjoyed this video, please hit that thumbs up button as well. It means a lot to me. Catch you in the next video. Change the entire industrial real estate.
Drew, also I heard you just like...
No, it wasn't Drew's fault. You gotta scroll up a bit though. That's my fault. Entire industrial real estate. Apparently can't read. Okay. This is why you guys get paid. You guys get paid to put up with this. Place in Michigan. Oh, no, I screwed that one up.
And Michigan?
The wheels are falling off on this this go around here.